Okay, so get this. Businesses today are sitting on over 3% of all the Bitcoin out there.
Wow.
And that's not a small thing. We're talking a 500% increase in just a few years.
That is a big jump. That really suggests a shift, beyond just people speculating.
Yeah.
It seems like companies are really thinking differently about how they handle their finances.
Yeah, absolutely. And we got some really good stuff to look at today.
Yeah.
We've got, some info on businesses adopting Bitcoin, right? Like using it as an actual treasury asset.
Right.
But also we've got this kind of parallel thing happening with these exchange-traded funds, those ETFs everybody's talking about.
Yeah, ETFs are getting a lot of attention lately.
For sure. So our mission today is to really try and cut through the noise, right?
Yeah.
Figure out, why are businesses going for Bitcoin? What's driving this? And something I find really interesting is, why are they choosing to hold the actual Bitcoin when there are these ETFs that seem like maybe an easier way to get involved?
Right.
So we'll get into all that.
Yeah, let's dive in.
And also, what's going on with this whole active ETF thing? What does that tell us about how people are thinking about investing these days?
Yeah, that's a good point. It's like a window into investor sentiment.
So to kick things off, I guess the first question is, when did this whole business Bitcoin thing really start to take off?
Well, the stuff you dug up shows a few early birds, even before 2023. Companies like Block.one and Galaxy Digital. But, the thing is, those are companies that were already kind of in the crypto world, right?
Right, so you'd almost expect them to be ahead of the curve.
Exactly. So it wasn't a huge surprise. But then there's this big turning point in 2020 with MicroStrategy.
Yeah, what was it about them that was so important?
Well, MicroStrategy, they're a business intelligence company, and software and stuff. They went all in. They didn't just buy a little Bitcoin. They converted a huge chunk of their treasury.
Wow.
Cash, equivalents, everything, into Bitcoin. We're talking 21,000 Bitcoins, $250 million.
That's a serious commitment.
It was a huge statement. And the big takeaway here, they weren't a crypto company.
Right.
This was a sign that, hey, companies outside of that world, they're starting to see Bitcoin not just as something to gamble on, but as a core part of their financial strategy.
So that kind of opened the floodgates then.
Yeah, you could say that. It gave other businesses a reason to really take it seriously.
Okay, so MicroStrategy legitimized it, but the real acceleration was in 2024.
Right, 2024 was huge.
What changed in that year?
Well, the data really points to two big things. The first one's liquidity.
Okay, so liquidity. That's how easy it is to buy or sell something without the price going haywire. Right?
Exactly. Now, think about Bitcoin before, like 2018. Back then, the daily trading volume was rarely over $100 million.
Okay.
Now, fast forward to 2024, we're seeing volumes over $10 billion regularly.
It's got to be one of the biggest jumps ever.
It's massive.
Yep.
And here's the thing. Data from Kaiko shows that in 2024, you needed at least $250 million of buying or selling to move Bitcoin's price by just 2%.
So that's a good thing for businesses, right?
Absolutely. It means they can move serious money in and out of Bitcoin.
Right.
Without freaking out the market. You don't want your treasury strategy to accidentally make things unstable.
No, for sure not. So way more liquidity. That's one piece of the puzzle.
Right. The second big thing is the new accounting rules.
Accounting. Not always the most exciting topic.
Well, no.
But it can have a huge impact, though.
Oh, for sure.
So what did they change?
Well, on December 13th, 2023, FASB, the Financial Accounting Standards Board, they announced this new rule. It said companies could now record their Bitcoin holdings at fair value. And this became effective in December 2024.
Okay.
Though companies could adopt it early if they wanted.
Okay, fair value. Can you break that down? What was the old way and why was it a problem?
So the old way was really messy. Companies had to track the lowest price their Bitcoin hit during a reporting period.
Okay.
So even if the price went up later, they were stuck with that low point on their books.
Oh, wow.
It made their assets look worse than they were. And, probably scared off a lot of companies from holding Bitcoin at all.
It makes it seem way riskier. Yeah.
Exactly. Now, with fair value, it's just the current market price. Simple, accurate, up-to-date. It gives you a much clearer picture of what a company's assets really are.
So it's a much more realistic way to look at it.
Way more realistic.
Right.
And FASB themselves said this. They said, measuring Bitcoin at fair value, it reflects the economics better.
Right.
And it also probably reduces the cost and complexity of the whole thing.
Yeah.
So it's a win-win.
So it's a more common sense approach.
Basically.
Yeah.
And that removed a big roadblock for companies thinking about Bitcoin.
Okay, so we've got more liquidity, we've got more sensible accounting.
Right.
But why are these businesses actually choosing to hold the Bitcoin itself?
Yeah.
Rather than, going for the ETFs that are now available?
Well, it boils down to the legal stuff. See, real Bitcoin is a commodity.
Okay.
But ETFs, even Bitcoin ETFs, they're securities. And that matters a lot under the Investment Company Act of 1940. That's the big one.
Oh, the 40 Act. That sounds like a whole other rabbit hole.
It is. But the basic gist is, if a company holds more than 40% of its assets in securities, it might get slapped with this label, investment company.
Oh, and that's a bad thing.
It's a whole different ballgame. Lots of extra costs, reporting requirements, things most businesses just don't want to deal with.
So we're talking like they'd have to register as an investment firm.
Yeah, exactly. More scrutiny, more rules, way more complicated.
So they're basically avoiding all that by holding the actual Bitcoin.
Exactly. It keeps things simpler. They stay out of that regulatory mess.
Okay, so that makes sense why they'd prefer the real thing.
Yeah.
But what about the ETFs themselves? Like, what are the downsides there?
Well, with an ETF, you've got counterparty risk. You're trusting the ETF provider to handle the Bitcoin properly.
Right.
And they charge fees, which can eat into your returns over time.
Yeah, that adds up.
It does.
Yeah.
And if you ever want to swap your ETF shares for actual Bitcoin, well, that could trigger a taxable event, plus trading costs.
So more things to think about.
Yeah, more complexity. So while ETFs might be fine for some investors, for businesses managing their treasury, direct ownership is usually cleaner.
Okay, that makes sense. But the fact that Bitcoin ETFs even exist, that's got to be a positive sign in itself, right?
But absolutely. It shows mainstream acceptance is growing. Institutions are getting comfortable with it.
Right.
And that makes it easier for a business to say, hey, this Bitcoin strategy isn't so crazy after all.
So it kind of gives it more legitimacy.
Exactly. It normalizes it.
Okay, let's shift gears a bit. Let's talk about why just hoarding cash can be a problem for businesses.
Yeah.
Like, why is that actually bad for their bottom line?
Well, in theory, a company's treasury should be there to cover operational costs and to, hold its value over time.
Right, make sure the money's there when they need it.
Exactly. And the rule of thumb is keep enough cash on hand to cover, say, 3 to 6 months of operating expenses.
Okay.
But a lot of businesses, they hold way more than that.
Yeah, for various reasons, I guess.
Right. Startups, they need a long runway to become profitable.
Makes sense.
Bigger companies, they keep cash for mergers and acquisitions.
Yeah.
Maybe smaller businesses might hold extra as a safety net.
Just in case.
Exactly. In tech companies, a lot of their value is in intellectual property.
Right. Stuff that's not so easy to sell quickly.
Right. So they might hold more cash to fund R&D or acquisitions. And sometimes companies hoard profits to delay taxes for their shareholders.
Okay, but isn't the big problem that cash loses value over time because of inflation?
That's the core issue. And you've got this great example with Apple.
Yeah, Apple. They're famous for having a ton of cash.
Huge cash pile.
Yeah.
Over the past decade, they've consistently had over $150 billion in their treasury, spread out across different things, securities, currencies.
Wow.
And their shareholders have done incredibly well. I mean, their share price is up over 1,000% since 2014.
Yeah, Apple stock has been a monster.
But here's the thing. Almost none of that gain came from their treasury.
Really?
Yeah. In fact, they estimate Apple's treasury actually lost over $15 billion in real terms.
You mean after inflation?
Yeah, adjusted for inflation.
Yeah.
Over a decade.
$15 billion. That's wild.
It shows you the real impact of inflation. And Apple's not alone. Any company sitting on tons of cash and low-yield stuff, they've probably seen the same thing happen.
So their money's just slowly shrinking.
Exactly. And the data points out that just handing out all that cash, like through dividends or buybacks, that's not always the best answer either.
Right, because it could make them more vulnerable during a downturn.
Exactly. So that's where alternative assets like Bitcoin come in.
Okay, because it's seen as more resistant to inflation.
Right. It offers a way to diversify and potentially protect against that slow bleed of value.
Makes sense. So we've talked about the inflation hedge. What are some other advantages the data highlights?
Well, one big one is the 247 liquidity. Bitcoin, it doesn't sleep.
Right.
Traditional banking, they've got their hours.
Right, Monday to Friday, 9 to 5.
Exactly. Which can be a problem for businesses that need to move money quickly, or if they rely on short-term credit.
So if something comes up outside of banking hours, they're stuck.
Pretty much. Bitcoin, on the other hand, transactions are always happening. Confirmed every 10 minutes, 365 days a year.
Wow, that's a huge difference.
It is. It means businesses that hold Bitcoin, they've got access to their money whenever they need it.
No matter what.
Exactly. No waiting for the banks to open.
That's got to be a huge advantage in today's world.
It is. And then there's the whole thing about bank failures. You know, the Silicon Valley Bank collapse in March 2023, that was a wake-up call.
Yeah, that made a lot of people nervous.
For sure. It reminded everyone about counterparty risk.
Right.
Now, with Bitcoin, you can self-custody.
Right. So you're not relying on a bank to hold your Bitcoin.
Exactly. You control your own assets, which is a big deal if there's financial instability or if you're in a risky jurisdiction.
So it's about control and peace of mind.
Exactly. You're not at the mercy of someone else.
Okay, so we've got the inflation hedge, the 24/7 liquidity, the protection from bank failures. But the data also says Bitcoin can be a strategic advantage for businesses, not just a defensive move.
It can be. A good treasury strategy, it's about balancing two things.
Okay.
Reducing risk and growing your wealth over time.
Makes sense.
Now, we saw with Apple, traditional safe assets, they might be stable in the short term, but they can lose value over time with inflation.
Right.
Bitcoin, it offers the potential for both. It lets you diversify away from those risks.
Okay.
And it has this built-in scarcity that could help it hold its value even as inflation goes up.
So potentially the best of both worlds.
In theory, yeah. And even a small allocation, say 1% to 5% of your treasury in Bitcoin, that can make a big difference in terms of diversification.
Oh.
And if you look at the returns over the past 5 years, Bitcoin has beaten the S&P 500, gold, bonds, everything.
So it's had amazing performance.
It has. And here's something that might surprise people. When you adjust for volatility, using this thing called the Sharpe ratio, Bitcoin's risk profile isn't that much higher than the S&P 500.
So it's not as crazy risky as some people think.
Exactly. It's all about perspective.
Okay, well, let's see how this is actually playing out in the real world.
Okay.
We've got these case studies of companies using Bitcoin. First up, Real Bedford FC, a football club in England.
Yeah. Real Bedford is interesting. They're owned by Peter McCormack since 2021.
Right.
And when he took over, the men's team was way down in the lower leagues.
Oh, wow.
But Bitcoin has become a huge part of their strategy. It's their main reserve asset.
Okay.
They're using it as a long-term investment to fund infrastructure as they try to move up the ranks.
So they're betting on Bitcoin for their future.
In a way, yeah. And it's not just about the money. Real Bedford, they really embrace the whole Bitcoin thing.
And like it's part of their brand.
Absolutely.
Yeah.
They're the first football club to go all in on Bitcoin.
Wow.
And it's helped them build a global fan base.
So it's reaching beyond just their local community?
Way beyond.
Yeah.
And their revenue streams are more diverse now. They've got sponsors from Bitcoin companies.
Excellent.
And online merchandise sales are booming, with over 10% of that coming from Bitcoin payments.
That's huge.
It is. Plus, their attendance at matches has gone through the roof.
So it seems like the Bitcoin thing is really working for them.
It is. McCormack, he talks about integrating Bitcoin into traditional business models. He believes sound money can really help a business succeed.
So it's not just about speculation, it's about running the business better.
Exactly. And Real Bedford, they've gained two big things: access to this global Bitcoin community and a Bitcoin treasury that could make them sustainable for the long haul.
And they've even got investment from Winklevoss Capital now.
Yeah, they're really leaning into it.
That's a cool story. Okay, another interesting one. Tahini's, a restaurant franchise in Canada.
Yeah, Tahini's. They started in 2012, and they've grown to 44 locations across Canada.
Wow.
They're even planning to expand into the U.S.
That's ambitious. But the restaurant industry, it's notoriously tough.
Oh, it is. Thin margins, constantly battling inflation, especially with food and labor costs.
Yeah, it's a constant struggle.
It is. But Tahini's, they've got this unique approach. They put 100% of their profits into Bitcoin.
Really? All of it?
Yeah, they call it their digital real estate. They're inspired by McDonald's and how they built their empire around real estate.
So Bitcoin's their property?
In a way, yeah.
Yeah.
They went all in on Bitcoin back in August 2020. They believe in it for the long haul.
It's a big bet.
It is. They keep about 6 months of cash on hand for operating expenses, but everything else goes into Bitcoin.
Wow.
And they buy it regularly to smooth out the volatility.
That's smart.
Yeah. And they self-custody it using a multi-signature wallet.
So they're not relying on a third party?
Nope. They control their own assets. They're in it for the long game. Their goal is to hold it for at least 4 years to ride out the ups and downs.
It's like a long-term savings plan for the business.
Yeah, their co-founder, Ali Hammam, he calls Bitcoin their pension plan.
That's an interesting way to look at it.
It is. It shows how a traditional business can think outside the box and use Bitcoin for long-term value.
Okay, let's move on to Adams, a shoe company in the U.S.
Yeah, Adams. They're based in Brooklyn, started in 2018.
Okay.
Making shoes is a capital-intensive business. You've got upfront cost for design, manufacturing.
Right, lots of money tied up before you even sell anything.
Exactly. Now, they became profitable in 2023.
Congratulations to them.
Yeah, and they're retaining all their earnings.
Okay.
And in 2020, they started putting some of their treasury into Bitcoin.
So they're diversifying away from just cash.
Right, and they started accepting Bitcoin payments too.
Oh, interesting.
Yeah, they even launched a Bitcoin-themed shoe in 2021.
So they're really embracing it.
They are. And get this, they don't convert the Bitcoin they get from sales right away. They hold on to it.
As an investment.
As a long-term investment. And they've noticed something interesting. People who pay with Bitcoin, they tend to spend more.
Oh, really?
Yeah, like twice as much on average.
But that's wild.
It is. And during that Silicon Valley Bank craziness, they thought about upping their Bitcoin holdings even more.
As a way to protect themselves?
Yeah, to manage their liquidity risk.
Mm-hmm.
So their plan going forward is to allocate a portion of their profits to Bitcoin.
Okay.
And also make some opportunistic buys, depending on market conditions and the price of Bitcoin.
So they're being strategic about it?
Exactly. This shows how a digital-first brand can weave Bitcoin into different parts of their business.
Yeah, from their treasury to their marketing even.
Right. It's not just one thing, it's a whole mindset.
Okay, next up, Peony Lane Vineyards. A winery?
Yeah, Peony Lane. They're in western Colorado, second-generation winemakers.
Okay.
They focus on natural wine, started selling in 2021.
So pretty new.
Yeah. They started locally, farmers markets, stores, that sort of thing.
Okay.
But then they went online and started accepting Bitcoin.
Why Bitcoin?
Customer demand, basically.
Yeah.
People in the Bitcoin community were asking for it.
Interesting.
Yeah, they saw it as a quality signal. They said something like, well, if we're accepting Bitcoin, our product better be damn good.
Ah, I like that.
Right. And they created this special thing, Satoshi's Reserve. 210 bottles, just for the Bitcoin crowd.
So they're targeting a very specific market.
They are. And it's paid off. The Bitcoin community is a big chunk of their customer base now.
So they found their niche.
They did. Online sales were 50% of their revenue in 2023. Now it's 75%.
Wow, that's a huge jump.
It is. Most of their customers are Bitcoiners, even if they're not paying with Bitcoin.
So it's attracting a certain type of customer.
Exactly. They use Square for their point-of-sale system, and they have it set up to automatically convert 1% of all their revenue into Bitcoin.
That's a cool way to do it.
Yeah. They've been doing that for 3 years, helps them grow their earnings.
Makes sense, especially in a capital-intensive industry like winemaking.
Right. Now they're going even further, focusing even more on the Bitcoin community.
So they're doubling down on what's working.
Exactly. It's a good example of how a small business can tap into a global community through Bitcoin.
Yeah, they're not limited by their location anymore.
Not at all.
Yeah.
And they're getting a premium for it, too.
Yeah, because Bitcoiners are willing to pay more for businesses that support Bitcoin.
Exactly. They're loyal.
Okay, and finally, let's circle back to MicroStrategy. They were kind of the pioneers of this whole thing.
Yeah, they're the big name everyone knows.
So how's their strategy playing out?
Well, they're still the most prominent example of a public company going big on Bitcoin.
Okay.
Since August 2020, they've been really smart about using the U.S. capital markets, issuing shares, offering debt, all to buy more Bitcoin.
And it's working.
Big time. Their market cap has exploded from $1.3 billion to $29 billion.
That's incredible growth.
It is. And their share price is up almost 900%.
Wow, way more than Bitcoin itself.
Yeah, they've outperformed Bitcoin by 93% since they started buying it, partly because of those smart capital raises.
So they're playing the market really well.
They are. For them, Bitcoin is their primary reserve asset. It's like 80% of their balance sheet.
That's a huge commitment.
It is. And their core business, the software, that brings in a steady stream of cash.
So they can service their debt and keep buying more Bitcoin.
Exactly. It's a well-oiled machine.
Yeah.
Now, it's not easy for other companies to copy exactly what they're doing.
Because they rely so much on the U.S. capital markets.
Right. But we are seeing companies like Metaplanet in Japan.
Okay.
They're trying similar things in different markets.
Interesting. So MicroStrategy, they're really showing what's possible?
They are. They've changed the way people think about corporate treasuries.
Okay, so we've looked at all these businesses using Bitcoin.
Right.
But you also brought some interesting info about active ETFs. What's driving that trend in the wider investment world?
Well, there's a definite shift happening. More and more people are moving towards active management, especially in ETFs.
So not just the regular index tracking ETFs.
Right. It's about having a fund manager who's actively making decisions, trying to beat the market.
And why is that happening now?
Well, things are getting more volatile. There's more uncertainty.
Right. The world's a crazy place.
It is. And in times like these, people want experts, people who can navigate the choppy waters.
So they're looking for an edge.
Exactly. They want more than just average returns.
Okay.
And ETFs, they offer a way to get that active management in a structure that's efficient and transparent.
Easier to understand than a mutual fund, maybe.
Yeah, exactly. So it's like this perfect storm. Active management is in demand.
Yeah.
And ETFs are the ideal vehicle.
So it's a trend that's here to stay.
It seems that way. Some people are even calling it a new era of active ETF innovation.
So there's a ton of new products coming out.
A ton. The numbers are pretty crazy. Back in 2021, active ETFs were about 25% of all new ETF launches globally.
Okay.
By 2024, that number is almost doubled. Almost half of all new ETFs are actively managed now.
Wow, that's a huge shift.
It is. And BlackRock, they're predicting global assets in active ETFs to hit $4 trillion by 2030.
That's 4 times what it is now.
Exactly. In just 6 years. So the appetite for active ETFs is huge.
Massive growth.
Yeah. BlackRock, they launched their first active ETF back in 2013.
Okay.
And they've been expanding ever since.
So they're all in on this trend.
They are. They see the demand, and they're catering to it.
Okay, but why are active ETFs so popular right now? Like, what's making them take off?
Well, like we said, there's more volatility.
Right.
And that makes active management more appealing. People think active managers can outperform in those conditions.
Yeah.
They can maybe achieve specific goals or get exposure to parts of the market that are harder to index.
So it's about customization and flexibility.
Exactly. And active ETFs, they offer all that within the ETF structure.
So you get the benefits of both.
Right. It's convenient. It's often more tax efficient than a mutual fund.
Okay.
And it's easy to trade, just like a stock. So it's making sophisticated strategies more accessible.
So I guess the takeaway is, if you're an investor, active ETFs are definitely something to consider these days.
Absolutely, especially in this market.
Okay, now the data also briefly compares active ETFs to investment banks.
Yeah.
How do those two things relate to each other in the bigger picture?
Well, it's important to remember that they're not really the same kind of thing.
Okay.
Active ETFs, they're an investment product.
Right.
It's a way for people to put their money into different assets.
Makes sense.
Investment banks, they're more like intermediaries in the capital markets.
Okay.
They help companies raise money.
Through IPOs and stuff.
Exactly. They underwrite bonds. They help companies go public.
They're facilitators.
Yeah, they connect companies that need money with investors who have money.
So they play different roles, but they're both important.
Absolutely. Active ETFs are about how people invest, while investment banks are about how capital flows through the system.
Gotcha. Okay, one last thing. The info you provided also talks about institutional investors and digital assets.
Yeah.
So Bitcoin and all that. What's the sentiment there? Are the big players getting involved?
Well, despite all the ups and downs in the crypto market.
Right. It's been a wild ride.
It has. But a survey by EY Parthenon, they talked to over 250 institutions.
Right.
And the takeaway is they're mostly staying the course.
So they're not scared off?
No. Their approach is tempered optimism. They see the long-term potential.
But they must have some concerns, right?
Oh, for sure. The big ones are regulation.
It's still a bit of a Wild West out there.
It is. And they want to find trustworthy partners.
Makes sense.
And, of course, security is a big one. Making sure their digital assets are safe.
Yeah, that's crucial.
It is. But despite those concerns, they see the value.
In terms of diversification and potential returns?
Exactly. Right now, a lot of these institutions have already put some money into digital assets.
So they're dipping their toes in.
Yeah. And a lot of them plan to increase their allocations in the next couple of years.
So they're seeing it as a long-term play.
They are. The most common investment is spot cryptocurrency.
So just buying Bitcoin and Ethereum directly.
Right. But over half of them are also investing in other things.
Okay, like what?
Funds that track crypto or private equity and venture capital and digital asset companies.
So they're looking at it from different angles.
They are. And there's also growing interest in this thing called tokenization.
Tokenization, can you explain that?
Yeah, so basically it's about taking real-world assets, like stocks or real estate, and turning them into digital tokens on a blockchain.
So it's like digitizing them.
Exactly. And institutions are interested in both investing in tokenized assets and maybe even tokenizing their own assets.
Wow, so they're really exploring the possibilities.
They are. They see potential benefits like access to new asset types, more liquidity, and more transparency.
So it's about efficiency and opening up new markets.
Exactly. So even the big institutions, they're not just watching from the sidelines anymore.
They're getting in the game.
They are.
Yeah.
And that's a sign that the digital asset space is maturing.
Okay, so to sum it all up for our listeners,
yeah,
businesses are increasingly adopting Bitcoin. Liquidity is improving. Accounting rules are better.
Right.
Holding tons of cash can actually lose you money because of inflation. Apple's a perfect example.
Yeah, that was a shocker.
Bitcoin can be a hedge against that.
It can.
And it's not just about the money. It can be part of your brand, build community, like with Real Bedford FC.
Right, they're the Bitcoin football club.
Exactly. And there's no one-size-fits-all approach. Tahini's, Adams, MicroStrategy, they're all doing it differently.
Right, different strokes for different folks.
And in the bigger picture, active ETFs are booming. People want active management in a volatile world.
And ETFs are a convenient way to get it.
Exactly. And the big institutions, they're not ignoring digital assets anymore.
They're exploring, they're investing.
The future's looking pretty interesting.
It is. It really makes you think. With all these changes happening, what does it mean for the future of finance?
Yeah.
What new opportunities are out there? What new risks? It's something for everyone to think about.
Absolutely. Well, this has been a great deep dive.
It has.
Thanks for joining us. We'll see you next time.
See you then.
Bye.